All right, welcome back to The Explainer. Today, we are diving deep into what might seem like a simple topic, but trust me, it's packed with details you'll need for your exam. Chapter 6, all about cash and receivables. My goal here is to cut through the textbook jargon and give you a super clear guide to master this stuff. So, let's kick things off with a real head-scratcher. How is it possible that a company like Apple, with a mind-boggling $98 billion in cash on its books, could actually have a cash flow problem? Well, the answer is wild. Turns out, a massive chunk of that, about $64 billion, wasn't even in the US. It was stuck overseas, unavailable for day-to-day operations. And that right there gets to the absolute core of what we're talking about today. See, not all cash is the same, and the details, they matter a lot. And believe me, Apple is not the only one in this boat. Take a look at this. You've got giants like Microsoft, Cisco, General Electric, all sitting on billions of dollars in what we call trapped cash held overseas. Yeah, it looks great on the balance sheet, but you can't use it to pay your US suppliers or hand out dividends. This is a really critical idea to grasp, the difference between having the cash and being able to access it. That's going to be a theme for us. Okay, so here's the game plan for today. Think of this as your roadmap to acing this chapter. First, we're going to figure out what cash really is in the accounting world. Then we'll jump into those business IOUs, you know them as accounts receivable. After that, we have to face the music and talk about bad debts. From there, we'll look at the more formal promises, notes receivable, and wrap it all up by seeing how companies can turn all those promises into cold, hard cash. Ready? Let's get into it. All right, section 1, let's start at the beginning. What do accountants actually mean when they say cash? You know, we all think we know what it is. It's the most liquid asset there is, but the official definition has some very specific rules you need to know. Okay, here's the golden rule for your exam. For something to count as cash, it absolutely must be readily available to pay off current debts. No strings attached. So that's the obvious stuff, right? Coins, dollar bills, but also things like money orders, certified checks, and of course, the money you have in the bank. Now, just as important, maybe even more so for a test, is knowing what is not cash. That post-dated check someone gave you? Or an IOU? Nope, that's a receivable. What about a travel advance you give an employee? That's actually a receivable or a prepaid expense. And postage stamps. Believe it or not, that's office supplies. Seriously, these little distinctions are classic exam fodder, so make sure you lock these in. All right, let's dig into a couple of special situations you're definitely going to see. On one hand, you have restricted cash. This is money the company has, but it's been earmarked for something specific, like building a new factory. The key is it's not available for general day-to-day use. And then on the other side, you have bank overdrafts. Now, you might think of this as negative cash, but that's not how it works in accounting. It's actually reported as a current liability, basically a short-term IOU to the bank. Okay, so we've nailed down what cash is, but what about the cash a company is still waiting to receive? That's our perfect segue into accounts receivable, all those informal IOUs business collects from its customers. So what are we really talking about with an account receivable? At its heart, it's just an oral promise from a customer that they're going to pay you later. The second a company sells something on credit, bam, it gets to record this promise as an asset on its books. It's a real legal claim to future cash. Now, companies want their cash sooner rather than later, right? So they often offer cash discounts for early payment. And for accountants, this creates a choice, the gross method or the net method. Think of it this way. With the gross method, you're an optimist. You record the full sale amount and only worry about the discount if the customer actually takes it. The net method is for the realists. You assume they will take the discount and record the lower amount up front. You only adjust it if they fail to pay on time. Knowing the difference between these two is a must for your exam. But of course, there's a downside to selling on credit, and it's a big one. Some customers just won't pay. This is the reality of business. It creates bad debts, and figuring out how to account for this is a super important part of managing receivables. Okay, you've got 2 ways to handle this, but listen up, because only one of them is the right way to do it under GAAP. First, there's the direct write-off method. It's easy. You just wait until you know for sure an account is a lost cause, and then you write it off. The problem? It's bad accounting. It totally violates the matching principle. The correct way, the GAAP way, is the allowance method. This is where you proactively estimate your future bad debts at the end of every single period. This gives a much more honest look at what your receivables are actually worth. So let's walk through the allowance method. It's a simple 3-step dance. Memorize this. Step 1, at the end of the period, you estimate the total amount you think you won't be able to collect. Step 2, you record that estimate.
You'll debit bad debt expense and credit a special account called Allowance for Doubtful Accounts. I want you to think of this allowance account as a big rainy day bucket for bad debts. Step 3, later on, when you find a specific customer who's definitely not paying, you write off their account against the allowance. You're taking a little bit out of that bucket you already filled. Notice you're not hitting the expense account again. That's key.
Okay, so how in the world do you come up with that estimate? You don't just pull a number out of thin air. One of the best tools for this is an aging schedule, just like this one for Aloha Coffee. Basically, you sort all your IOUs based on how long they've been outstanding. And here's the logic. The older an account gets, the less likely you are to ever see that money. So you apply a higher and higher percentage for uncollectability to the older buckets. It's way more precise than a single flat rate. And once you run all the numbers, the aging schedule gives you your magic number. For Aloha Coffee, it tells them their target for the allowance for doubtful accounts, that rainy day bucket, needs to be exactly $26,610. This isn't just a guess. It's their best, most educated estimate of what's likely to go bad. Okay, stop and listen. This is probably the #1 mistake people make on exams for this chapter, so pay close attention. The bad debt expense you're going to record for the period is not the $26,610. That's the ending balance you want in the allowance account. I want you to picture the allowance account as a beaker. The $26,610 is the line you need to fill it up to. The bad debt expense is only the amount of water you need to add to get from where you started to that line. Your journal entry is just the top-up amount. Get that, and you're golden.
All right, we've covered the informal handshake deals, accounts receivable. Now let's level up to something more formal. We're talking about notes receivable. These are the real deal. Formal, written promises to pay, usually with specific interest rates and due dates. They're a big step up. Now let's break down a concept that sounds really confusing at first, the so-called zero-interest note. Honestly, it's a terrible name because there is absolutely interest baked into it. Here's how it works. Look at the timeline. The company lends out a smaller amount of cash today, that's the present value, and in return, they get the full, larger face value back in the future. The interest is that hidden discount, that difference between the two numbers, and you recognize that as interest revenue over the life of the note.
And this schedule here is the key to understanding how that hidden interest gets recorded. We use something called the effective interest method. And what's important to remember is that you calculate the interest revenue each year based on the note's carrying amount at that time, not the original face value. You can see how year by year the carrying amount climbs up, and that process of recognizing the discount is called amortization. By the end, boom, it hits the $10,000 face value, right on the money. Okay, so picture this. A company's got a mountain of receivables. That's great. But what if they need cash, like right now? They can't always afford to wait 30, 60, or even 90 days for customers to pay. So this next part is all about the clever ways companies can speed things up and turn those receivables into immediate cash. When you need cash from your receivables, you've basically got two main options. On one side, you can straight up sell your receivables. This is called factoring. The big question here is who bears the risk. If it's without recourse, the buyer takes all the risk if a customer defaults. If it's with recourse, the original seller still has to guarantee the payment, so they keep some of the risk. The other option is not to sell them, but to use them as collateral for a loan. This is a secured borrowing. The company still owns the receivables, they're just pledging them to a bank to get a loan. This is a big deal for accountants. How do you know if it was a genuine sale or just a loan dressed up to look like a sale? Well, there are 3 conditions that all have to be met. 1, the receivables have to be truly out of the seller's hands. 2, the buyer has to be free to do whatever they want with them, pledge them, sell them again. And 3, the seller can't have any lingering control, like an agreement to buy them back later. If you fail even one of these tests, it's not a sale. The transaction gets booked as a secured borrowing. Okay, last piece of the puzzle. How do, as outsiders, look at a company's financial statements and judge how well they're managing all this? A fantastic tool for this is the accounts receivable turnover ratio. It basically tells you how quickly a company is collecting the money it's owed. Look at this example for Best Buy. You take their net sales, divide by their average accounts receivable, and you get a turnover of 31.4 times a year. But what does that really mean? Well, if you divide 365 days by that number, it tells you that on average, it only takes Best Buy about 11.5 days to collect cash after making a sale. That is crazy fast and tells you they're running a very tight ship. All right, as we wrap this up, I want you to take a step back from the journal entries for a second and think about the big picture. a company's policy on credit and bad debts. It's not just an accounting exercise. It's a window into their soul. It tells you about their business strategy and how they view their customers. Are they super aggressive, offering easy credit to anyone to grab market share, knowing they'll have more bad debts? Or are they really conservative, protecting their profits with strict payment terms? Remember this. Behind every number in that allowance for doubtful accounts, there's a story about risk, about growth, and about the kind of relationship a company wants to have with its customers. Something to think about. Thanks for tuning in, and I wish you the best of luck on your exam.